Now that we've covered how producers design a PRF policy, let's look at what happens after that policy is in place. In this section, we'll walk through exactly how an indemnity payment is calculated when a drought occurs. Although there are several steps involved, each one builds on the previous step, making the process fairly straightforward. One of the biggest advantages of PRF insurance is its simplicity. Unlike many other insurance programs, PRF does not require a claims adjuster to visit your operation, and producers are not asked to measure forage production or prove that a drought caused a specific amount of damage. This allows payments to be processed much more quickly than that of many traditional insurance programs, while eliminating much of the paperwork associated with filing a claim. The first step in calculating an indemnity is determining the amount of protection you've purchased. Two pieces of information are needed to begin. The first is the county base value. This is a dollar value assigned by the USDA Risk Management Agency that represents the value of forage production per acre within a county. Because forage productivity differs across the country, this value varies from county to county. The second piece of information is the number of acres you've chosen to insure. Not every producer chooses to insure every eligible acre. The number of insured acres simply reflects the portion of your operation you've decided to enroll in the policy. These values are the foundation for calculating the total amount of insurance protection available under your policy. Once the county base value is known, the next step is calculating what's called protection per acre. Protection per acre represents the amount of insurance coverage assigned to each insured acre. This calculation combines three factors: the county base value, your selected coverage level, and your chosen productivity factor. The formula is simple: county base value multiplied by coverage level multiplied by productivity factor equals protection per acre. Choosing a higher coverage level or selecting a higher productivity factor increases the protection assigned to each acre, while lower selections reduce both the protection and the premium. After calculating protection per acre, the next step is determining the operation's total protection. This represents the maximum dollar amount of coverage available under the PRF policy before any rainfall calculations are made. The calculation is protection per acre multiplied by the number of insured acres. Suppose the county base value is $10 per acre. The producer selects a 90% coverage level and insures 1,000 acres. If the producer chooses a productivity factor of 100%, the protection per acre would be calculated as $10 times 90% times 100%, resulting in $9 of protection per acre. Multiplying that by 1,000 insured acres gives a total protection amount of $9,000. Now let's compare that with a producer who selects a 150% productivity factor. The only thing that changes is the productivity factor. Protection per acre increases from $9 to $13.50. When multiplied across the same 1,000 acres, total protection increases from $9,000 to $13,500. This example illustrates why the productivity factor plays such a large role in the overall policy. Increasing it raises both the amount of protection available and the premium paid for that additional coverage. Once total protection has been calculated, the next step is deciding how that protection will be distributed throughout the year. This is done using allocation percentages. Each insured interval receives a portion of the total protection, and together those allocations must equal 100%. There are several rules producers must follow. Each insured interval must receive at least 10% of the total allocation. No individual interval may receive more than 60%. And altogether, again, the allocations across every insured interval must total 100%. One thing to remember is that each interval functions independently. If only one insured interval experiences drought, only that interval will receive a payment. Rainfall conditions in one interval do not affect payments in the others. Now that we've determined how much protection is assigned to each interval, we need to determine whether drought conditions actually occurred. This starts with understanding four terms. The historic rainfall average is the long-term average precipitation for a particular grid during a specific 2-month interval. The actual rainfall is the precipitation that was actually recorded during that same interval. The coverage level, also called the trigger index, is the percentage selected by the producer when purchasing the policy. Remember that these two terms refer to the same value. If a producer selects 90% coverage, then their trigger index is simply 90. This trigger index establishes the point at which an indemnity payment begins. Using these values, we can calculate two additional measurements. The first is the rainfall trigger level. This is the amount of rainfall corresponding to the producer's selected coverage level. And next is the rainfall index. The rainfall index compares actual rainfall with the historical average and expresses that relationship on a scale centered around 100. Rather than looking at inches of rainfall alone, the rainfall index tells us how wet or dry the interval was compared to what is normally expected. Let's put all these pieces together. In this example, the historical rainfall average for the interval is 4 inches. The producer selected a 90% coverage level, creating a rainfall trigger level of 3.6 inches. Suppose the actual rainfall received during the interval was only 2.5 inches. To calculate the rainfall index, divide the actual rainfall by the historical average and multiply by 100. 2.5 divided by 4 multiplied by 100 gives a rainfall index of 62.5. Now compare that value with the producer's trigger index of 90. Because the rainfall index of 62.5 falls below the trigger index of 90, the policy qualifies for an indemnity payment. At this point, we know the producer is eligible for a payment. Now that we've confirmed a payment has been triggered, the next question is how much will the producer receive? To answer that, we calculate what's called the payment factor. The payment factor represents the severity of the rainfall deficit. In other words, it measures how far below the producer's trigger index the rainfall index actually fell. The formula is trigger index minus actual rainfall index divided by the trigger index. As the rainfall deficit becomes larger, the payment factor also becomes larger. This means that more severe drought conditions result in a greater percentage of the insured protection being paid. The producer selected a 90% coverage level, so their trigger index is 90. We've determined that the rainfall index for this interval is 62.5. To calculate the payment factor, subtract the rainfall index from the trigger index. 90 minus 62.5 equals 27.5. Next, divide 27.5 by 90. This gives a payment factor of approximately 0.31, or 31%. This tells us that 31% of the protection assigned to that interval will be paid as an indemnity. Now we're ready to calculate the actual dollar amount the producer receives. The first step is calculating interval protection. Remember that each insured interval only receives a portion of the producer's total protection based on the allocation percentages selected when the policy was purchased. To calculate interval protection, multiply the producer's total protection by the allocation percentage assigned to that interval. Once we know the interval protection, we multiply it by the payment factor we just calculated. That final number is your interval indemnity. In other words, the interval indemnity represents the payment generated by one specific coverage interval, after accounting for both the amount of protection assigned to that interval and the severity of drought. Suppose a producer has $9,000 of total protection under their PRF policy. They allocated 60% of that protection to the March through April interval, and 40% to the May through June interval. Now imagine that only the May through June interval experienced enough drought to trigger a payment. The first step is calculating the protection assigned to that interval. $9,000 multiplied by 40% equals $3,600 of interval protection. Earlier, we calculated a payment factor of 0.31. Multiplying $3,600 by 0.31 results in an indemnity payment of approximately $1,100. That is the amount the producer would receive for that specific interval. This example illustrates that even though the producer insured multiple intervals, only the interval that experienced qualifying drought conditions generated a payment. Of course, drought doesn't always occur during just one part of the year. If multiple insured intervals experience rainfall below the producer's trigger index, each qualifying interval is calculated independently using the same process we just covered. Each individual interval payment is added together to determine the producer's total indemnity for the policy year. This makes sure that PRF provides accurate protection across multiple parts of the growing season, whenever widespread drought occurs. First, the county base value. In this example, the county base value is $10 per acre. Step 2 is selecting the coverage level. Our producer chooses a 90% coverage level. In PRF, the selected coverage level also establishes the trigger index, so with 90% coverage, the trigger index is 90. Step 3 is determining the number of insured acres. In this example, the producer is insuring 1,000 acres. Step 4 is selecting the productivity factor. For this example, we will use a productivity factor of 100%, meaning no adjustment is being made to the county base value. With those numbers established, we can move on to Step 5 and calculate protection per acre. We take the $10 county base value, multiply it by the 90% coverage level, and then multiply that by the 100% productivity factor. $10 times 90% times 100% gives us $9 of protection per acre. Next, in Step 6, we calculate the total protection for the policy. We multiply the $9 of protection per acre by the 1,000 insured acres. That gives us a total protection amount of $9,000. Now, we need to look at how that protection is distributed across the selected rainfall intervals. In this example, the producer has allocated 40% of their protection to the March-April interval and 60% to the May-June interval. For the purposes of this example, the rainfall index is 62.5 in both intervals. Remember that the rainfall index reflects rainfall within the producer's PRF grid, compared with the historical rainfall data used by the program. Because our trigger index is 90 and the actual rainfall index is only 62.5, both intervals are below the trigger. That means an indemnity can be potentially paid for both intervals. Step 8 is calculating the payment factor for each interval. The payment factor is calculated by subtracting the rainfall index from the trigger index and then dividing that difference by the trigger index. So here, we take 90 minus 62.5, which gives us 27.5. We then divide 27.5 by 90. That gives us a payment factor of approximately 0.31, or 31%. Because both intervals happen to have the same rainfall index in this example, they also have the same payment factor. In an actual policy, the rainfall index can be different for each interval, which means each interval may have a different payment factor. Now, we can calculate the indemnity for each interval. First, let's look at March through April. 40% of the $9,000 total protection was allocated to this interval. $9,000 multiplied by 40% gives us $3,600 of interval protection. We then multiply the $3,600 by the payment factor of 0.31. That gives us a March-April indemnity of approximately $1,116. Next is the May-June interval. 60% of the total protection was allocated here. $9,000 multiplied by 60% gives us $5,400 of interval protection. We multiply that amount by the same payment factor of 0.31. That produces a May-June indemnity of approximately $1,674. Finally, in Step 10, we add the indemnities from the two intervals together. $1,116 plus $1,674 gives us a total indemnity payment of approximately $2,790. So, using this example, a producer with 1,000 insured acres, a $10 county base value, 90% coverage, and a 100% productivity factor would have $9,000 in total protection. With rainfall indexes of 62.5 in both selected intervals, the resulting indemnity would be approximately $2,790. This concludes our discussion on how your possible indemnities are calculated. In the next sections, we'll cover how to use the USDA's Decision Support Tool and the University of Utah's Farm Analysis Tool for historic rainfall data.